Are you hedging your duration risk?
Well, it's not that, the duration is higher, so mathematically it's more sensitive, but you see that it's very often reversely correlated with it, so it's not that sensitive. Of course, you could still decide to hedge interest rate risk, and then maybe you get a double performance of it, but it might increase the volatility of your fund.
Do you see some kind of stabilization in high current account deficit crunches?
I think it's very interesting. EM, when you look at it, it corrected more than anything else, as well local bonds as external bonds. Now, to explain that, you really need EM-specific reasons, and there were not really a lot of them. Yes, growth did disappoint a little bit in EM, but it's still much better than in the developed world. So that's not a big reason. I think people were really afraid about tapering, but really doesn't matter. Tapering doesn't matter. But they're afraid about probably the interest rates increases you may have after that stadium. If QE stops, then at some point you will have interest rate rises in the US. But when you look to it, and they probably said, well, are you going to sell those assets with the highest duration? But when you look to it and how it reacted in the past, when the Fed is tightening, EM spreads did come in quite massively.
Do you see a deterioration among the corporate sector in emerging markets?
Well, among some you see that, but we are not really corporate investors, so we don't do it so much. But you can see there is a lot of issuance of corporates, but the issuance very often did not increase leverage, so I would not be too negative. It's mainly in issuance to pay back more expensive debt, like bank loans and those kind of things. So very often issuance was good for corporate quality. I would not be overly negative there.